Hello, my name is Abhishek Jain, and I welcome you all to this episode of the Friday Fundamentals with Chartmojo. In this episode, we'll be taking a deep dive into the business of Jubilant Foodworks, which operates two international chains, namely Domino's Pizza and Dunkin' Donuts. लेकिन शुरू करने से पहले, if you haven't already subscribed to our channel, consider subscribing and do share this video if you like it. Jubilant Foodwork, which is the part of Jubilant Bhartiya Group, is the largest food service company in this country. It, as you all know, has one of the most effective and far reaching delivery models in this country. And the company also operates in two international brands, Domino's Pizza in India, Sri Lanka, and Bangladesh, and Dunkin' Donuts in India. So other than Domino's Pizza and Dunkin' Donuts, company also operates Hong's Kitchen, which is the Chinese cuisine with a homegrown brand. Hong's Kitchen was launched in Gurugram in March 19, and the brand stands for Chinese food custom to Indian preferences at an affordable prices. Jubilant Food also entered into the FMCG segment with the launch of ready to cook range of products under the brand Chef Boss, which mainly focuses on two types of cuisine, namely Indian and Chinese. In December 2020, Jubilant Foodworks announced the launch of biryani, kebabs, and curries under the brand Ekdum in an attempt to establish a presence in the Indian cuisine segment. And recently, in March 2021, JFL announced signing of an exclusive master franchisee to own and operate Popeye stores in India, Bangladesh, Nepal, and Bhutan. Moving forward, let's talk about the QSR industry, that is the quick service restaurant industry in this country. The QSR industry has been growing phenomenally over the past one decade, and there are some reasons why it is so. So let's look into them carefully. Number one being the younger demographic. India has the largest number of millennials living in this country. Millennials are nothing but people from the age group of 15 to 34, and India has about 50 crore of them. And since this age group, the millennials, are expected to grow even faster than the other age groups, this bodes well for the QSR industry. The second point being urbanization. Especially if you see in the urban cities, people don't have time to cook food for themselves. So, what happens in this process is people order food online or they tend to go out and eat. The third point being the focus towards the Indian centric offerings and value pricing. The next point being the success of the food delivery service across the country. We can also see a growing acceptance of online food delivery in tier 3 and tier 4 cities where major chunk of demand is going to come from in the future. Also, we cannot ignore the fact that there has been high penetration of internet across rural and urban India. Though we can see that the food delivery service of Zomato and Swiggy is available for every individual restaurant, then why is it that large chains of KFC and Domino's is working so well and in fact better than others? The reason is fairly simple. There has been a shift from the unorganized segment to the organized segment in the food industry. So, what I mean by that is people are preferring to eat in the places where they know that the quality of food cannot be hampered with and they'll get the same taste across the region wherever they go. Also, not to mention the standard towards the safety and hygiene that these large chains maintain. Now, with all this industry insights, let's look into the strengths of Jubilant Foodwork. Point number one, its dominant market share. Domino's has over 70% market share in the online delivery of pizzas across India, and it also has around 55% market share in the organized pizza segment in this country. To have such a dominant market share in a country like India, Jubilant Foodwork is in a commanding position as it has a exclusive rights for the Domino's pizzas in this country. And because of its strong foothold in the Indian market, the company has been able to clock over 17% CAGR in its revenue growth since the past 10 years. Currently, the company has more than 1,550 stores across the brands, and it also is operating in more than 320 cities. And now you must be thinking if there is more space to grow. Well, in India, there are more than 700 cities and towns with more than 1 lakh of population. And thus, we can see that Domino's has more than 50% of the market to capture. And with this strong foothold in this country, we don't see any reason why it can't do the same. Let's look into the liquidity of the company. The company's free cash flow has remained positive since the past 4 years, and that is aided by two factors mainly, and those are robust profit generation and a negative working cycle. If you look into these numbers, you can clearly see that the working capital days of Jubilant Food has largely remained negative. And this you can see that it's been consistent since the past 10-11 years. If we talk about FY21, since FY22 numbers are not out yet, we can see that the company generated free cash flow of around rupees 283 crore rupees. Whereas in FY20, the company generated free cash flow of rupees 11 crores. However, if we see that company has incurred some capex and will continue to do so as it is planning to expand across the country, and that would require some funds, and that we believe would largely be funded through its internal accruals only. The company also has a strong cash and cash equivalent balance, which stood at rupees 539 crores at the end of FY21, which was around 655 crores in FY20. But if we move away from these numbers, we all know that the company is facing some strong headwinds, and you can say that the company indeed is in a perfect storm. We can see that the stock has been underperforming quite a lot, and at one point of time, it was down about 47% from its high. Now, there are many reasons why that happened and why we are saying that the company was in a perfect storm. Starting with the FII selling. Now, if you look here, you can clearly see that FIIs were holding near about 41% of the company's equity shares until September 2021. But now, if you see, the number has come down to 32%. And that is obviously clearly reflected on the share price of the company. Whether it was about the rich valuations of Jubilant Foodworks that prompted the FIIs to sell the stock, we don't know. But we all know that the FIIs are consistently moving out their capital from India since October 2021. Moving ahead, we can clearly see that there was another sustained pressure on the stock near the end of this 2021 year. And the reason is very clear. The last 2 weeks of December is generally when the companies like Domino's and Dunkin' Donuts have their most sales, because it is the holiday season and people generally like to eat out. But due to the COVID related restrictions that prompted that dining out was limited to only 50% of the capacity, and plus there was a curfew in place after 9 p.m. in most of the cities across India, that led to a downfall in the demand for pizzas and other restaurants that Jubilant operate. Later, we can see a recovery in the price, but that quickly turned into a downtrend again, and this was credited to the muted numbers of Jubilant Food. And there was one particular item that the company decided not to disclose, and it is a very important number for any QSR chain, and that number was same store sales growth. So the company, instead of posting their same store sales growth, they decided to post like for like growth, which essentially means that company decided to disclose the numbers of similar stores in terms of area, in terms of square feet, and in terms of demand. So company posted 7.5% of LFL, but we have closely looked into the numbers back in 2019, that is FY20 numbers. If you see, the company from then on has increased their stores to about near about 11 to 12%, and their sales from then on has also increased to about 12 to 13%, which clearly shows that the same store sales growth in Domino's and other QSR run by Jubilant is not more than 1 to 2%, but instead the company posted 7.5% of LFL. Well, there is a reason why the company decided to go for LFL numbers, but the analysts didn't take it well. Well, the reason why company posted LFL numbers instead of SSSG was that the company is trying to expand into the already penetrated areas. So what happens is, if there is already a store, the company is opening another store nearby to meet the demands for their 20-minute delivery service. So the company has called their old store the mother store and the new store as the split store. Because of this new mother store and split store strategy, the numbers from the mother stores have started to come down. And that's why the company has not posted their SSSG number. According to the management, the mother stores will take about 2 to 3 years to come back to their original revenue numbers. But since there is no clarity about the performance of the company, the stock took a beating. And later came the invasion of Ukraine by Russia and consequently sanctioning of the Russian economy. Now, if you read this circular, you'll realize that Jubilant Foodworks indirectly holds about 49.99% ordinary shares of DP Eurasia. Well, what is DP Eurasia? If you Google DP Eurasia, you'll come to know that it is a company that is the exclusive master franchisee of the Domino's pizza brand in Turkey, Russia, Azerbaijan, and Georgia. Now, however, the Domino's branch is still running in Russia. There is an uncertainty in the environment because of lot of sanctions that is going on from USA and Europe. And after all this downfall came the final blow for the company, and that was the resignation of its CEO, Mr. Pratik Pota. Now, this was not a normal resignation, and it was a surprise for both the stakeholders and the management of the company. The move indeed was a surprise, as the management approved the reappointment of Mr. Pota for next 3 years. Mr. Pratik played a pivotal role in the turnaround of the franchisees. Now, if you look in the last 5 years since his appointment, he took some several measures to improve the SSSG numbers by weeding out certain practices of the past that led to the erratic performance of the stores. Now, during Pota's tenure, the SSSG number, which was hovering around 1% from FY14 to FY17, went up to 9% CAGR from FY17 to FY22. Now, to match that number will be very crucial for the next CEO, and the market knows it won't be a smooth sailing for the next CEO. The company has also been facing huge margin pressure due to the macro headwinds, and though the company has successfully passed on the incremental cost to the consumers, it would be very interesting to see how they continue to do it as the inflation numbers keep on rising. Now, since the Q4 numbers and the FY22 numbers are not out yet, let's look into the Q3 numbers. The revenue from operations was up by 12.9%. The company saw strong momentum in delivery and takeaway channel. The recovery was around 128% in delivery, and there was a 148% recovery in takeaway channel versus the Q3 of FY20. The EBITDA margin was consistent around 26.6%, and the profit margin was around 11.5%. During this quarter, JFL opened around 75 new Domino's pizza stores, and this is a record number, and the company is hoping to open around 200 stores in FY22 alone. The company also saw highest ever Domino's app downloads in this quarter at 82 lakhs, and now it has a coverage of around 322 cities across India. However, the numbers of Dunkin', Hong's Kitchen, Ekdam, Popeyes, and Chef Boss was not that encouraging. Moving forward, the company has mentioned five key areas where it wants to focus. Number one being making Domino's Pizza more dominant across India. Second point being the company wants to focus on innovation and providing value to the consumers. The company also wants to grow internationally and through other geographies. Next up, the company wants to use data and digital strengths to minimize its cost. And of course, the company wants to build new brand portfolios. Now let's look at the shareholding pattern of the company as of March 2022. Promoters are holding around 41.94%, FIIs are holding 31.87%, TIIs are holding 15.59%, government has around 0.13%, and public has around 10.22%. The company is expected to keep its operating profit margin at about 25% and its dividend payout ratio near about 33%. The company's ROE in the past 10 years is at 22%. Its stock price CAGR in the past 10 years is 18%. Its profit growth in past 10 years is 12%, and the sales growth in past 10 years is 17%. Though the stock is currently trading at around 37% below its all-time high level, the stock might continue to remain under pressure until the new numbers come out. That's all from our side. I hope you like our content. If you do, then consider subscribing to our channel and don't forget to share it with your friends and family. I'll see you in the next week. Till then, take care and bye bye.